Hello everyone, and here are the details of today's video. The news that China has accumulated nearly $1 trillion in trade surplus within just 11 months is not simply an economic data point, it is a historical marker. It signals the end of one era and the unmistakable arrival of another. For decades, the world operated on the assumption that the United States was the gravitational center of global trade, the indispensable consumer market whose demand sustained the industrial expansion of others. Yet China's extraordinary surplus, achieved even as exports to the United States declined sharply, reveals a profound truth. The world economy is no longer Atlantic-centered. It is shifting quietly but decisively toward a more diffuse and multipolar landscape. $1 trillion surplus is not the product of luck or a temporary swing in commodity prices. It reflects the maturation of a complete industrial ecosystem, the kind that few nations in history have ever possessed. China is now the only economy that can produce scale and export across the full technological spectrum, from basic materials to the most sophisticated electronics and renewable technologies. It controls supply chains not through coercion, but through capacity, cost, efficiency, and a staggering breadth of manufacturing expertise. The surplus is, in a sense, the world's acknowledgement of this reality. But what makes this moment especially consequential is the paradox behind the numbers. China achieved this surplus despite a collapse in exports to the United States, the very country that once served as its largest and most profitable market. 2 decades ago, such a decline would have spelled crisis. Today, it hardly registers because China has diversified its export geography. ASEAN, the European Union, the Middle East, Latin America, and Russia have absorbed the slack, often eagerly. The global economy is silently reorganizing itself around new trade corridors that no longer depend on American consumption. This shift carries deep geopolitical implications. Trade surpluses of this magnitude translate into financial power, currency reserves, industrial reinvestment, technological upgrading, and geopolitical leverage. They allow China to finance large-scale infrastructure projects abroad, expand its influence across emerging markets, and withstand economic pressures from the West. $1 trillion surplus, in other words, reinforces a long-term structural trend. China is becoming the economic hub of a world no longer anchored solely by the United States. Yet behind this transformation lies another story, one of discomfort in Washington for U.S. policymakers. China's ability to grow its surplus, even while American tariffs remain in place, raises troubling questions. Are tariff barriers ineffective in a world of shifting supply chains? Has U.S. domestic manufacturing become too hollowed out to compete? And perhaps most unsettling, if the world can sustain growth without relying on American demand, what becomes of America's traditional leverage over global trade? These are not abstract concerns. They reflect a deeper anxiety that the United States is gradually losing the ability to shape the global economy in its own image. The $1 trillion surplus is therefore not merely China's achievement, it is a mirror held up to a world in transition, one in which old assumptions erode and new centers of gravity emerge. The decline of Chinese exports to the United States once would have been interpreted as a sign of economic trouble, a rupture in the most consequential bilateral trade relationship of the modern era. But today, it has produced the opposite effect. China's trade surplus continues to rise, not because it leans on the American consumer, but because it has successfully woven itself into the fabric of a new global marketplace. The question is no longer how dependent is China on the U.S. market, but rather who has replaced the United States as China's primary engine of export growth. The first and most important answer is ASEAN, which has quietly surpassed the United States to become China's largest trading partner. The Southeast Asian region, vast, youthful, rapidly urbanizing, is absorbing Chinese machinery, electronics, energy infrastructure, and consumer goods at a staggering pace. China's supply chains now run through Vietnam, Thailand, Malaysia, and Indonesia with remarkable fluidity. In many cases, Chinese firms manufacture intermediate goods domestically, ship them to ASEAN for final assembly, and then re-export them globally. The region has become both China's factory partner and its customer, a dual role the United States once held alone. A second pillar of China's export resilience is the European Union. Despite complaints from Brussels about Chinese overcapacity, Europe remains deeply reliant on Chinese electric vehicles, batteries, solar panels, medical equipment, and electronics. The energy crisis that followed the war in Ukraine pushed European industries toward cheaper imports, many of which China provided at scale. Europe's environmental ambitions, though admirable, have paradoxically deepened its dependence on Chinese green technologies. For every megawatt of solar installation or new EV mandate, Europe quietly imports the hardware from China, ensuring Beijing's continued export strength. A third emerging market is Russia, which after Western sanctions has turned overwhelmingly toward China for everything from consumer goods to automobiles to industrial machinery. The reorientation of the Russian economy, once tied to Europe, now flows through Chinese ports and pipelines. It is a structural shift that may outlast the war itself. Yet the story does not end there. The Middle East, South Asia, Latin America, and Africa are becoming increasingly central to China's export strategy. They are regions of rapid population growth, infrastructure expansion, and rising consumer markets, precisely the environments where China's competitive advantages thrive. Chinese construction firms build their railways and ports. Chinese telecommunications networks connect their cities. Chinese consumer goods stock their shelves. What all these regions share is not ideology, but pragmatism. They seek affordable infrastructure, reliable industrial goods, and long-term financing resources China can provide with unmatched scale. Their growing integration with the Chinese economy is not primarily geopolitical, but developmental. For the United States, this recalibration raises a profound concern. China's rise is no longer tethered to American demand. It is anchored in a global South awakening, in the economic modernization of regions once dismissed as peripheral. China's export geography reflects a world in which growth no longer flows through the old Atlantic arteries, but through new corridors spanning Asia, Eurasia, and the developing world. In essence, China has diversified not merely its markets, but its role in the global economy. It is no longer exporting to America alone. It is exporting to the future. To understand why China's trade surplus continues to expand even as exports to the United States shrink, one must look beyond short-term fluctuations and examine the deeper architecture of China's economic model. China today is not merely a large exporter. It is the world's most comprehensive industrial ecosystem, a system so vertically integrated and technologically mature that it can withstand external shocks that would destabilize other economies. This structural advantage explains why China's surplus grows even in adverse conditions and why attempts to contain it through tariffs or political pressure often fail. The first structural factor is scale. China is the only country on Earth capable of producing at every stage of the value chain, from rare earth processing to advanced chip packaging, from steel making to electric vehicle assembly. This scale reduces costs, accelerates learning curves, and enables China to offer goods at prices no Western country or even most Asian rivals can match. The economies of scale achieved in batteries, solar panels, and EVs are not cyclical. They are structural, forged through years of large domestic demand and relentless industrial upgrading. Second, China possesses a complete supply chain ecology, a concept often underestimated in the West. Manufacturing does not thrive on isolated factories. It thrives on clusters, networks of suppliers, logistics hubs, specialized labor, capital markets, and research centers. In China, these networks are dense, coordinated, and geographically optimized. A factory can source dozens of inputs within a few kilometers. Western economies, fragmented by distance and regulatory inertia, cannot replicate this efficiency. Third, China's industrial strength is sustained by a strategic blend of state support and market competition. Producers face logistical constraints. China runs its industrial machine at high reliability and low cost. Fifth, China's technological base is no longer imitative but innovative. It leads the world in EV batteries, photovoltaics, AI-driven manufacturing, industrial robotics, and high-speed rail. These technologies are not niche industries. They are the backbone of the 21st century economy. They feed directly into export surpluses. Finally, China's domestic market, 1.4 billion people, absorbs enough production to sustain industrial learning at unmatched volumes. When domestic demand slows, excess capacity flows naturally into global markets, reinforcing China's export momentum. Producers face logistical constraints. China runs its industrial machine at high reliability and low cost. Fifth, China's technological base is no longer imitative but innovative. It leads the world in EV batteries, photovoltaics, AI-driven manufacturing, industrial robotics, and high-speed rail. These technologies are not niche industries. They are the backbone of the 21st century economy. They feed directly into export surpluses. Finally, China's domestic market, 1.4 billion people, absorbs enough production to sustain industrial learning at unmatched volumes. When domestic demand slows, excess capacity flows naturally into global markets, reinforcing China's export momentum. These structural factors combined mean that China's surplus is not simply a measure of current trade flows. It is a reflection of industrial supremacy. Attempts by the United States to isolate China or reduce imports have merely redirected China's exports elsewhere. The world's demand for affordable, reliable industrial goods has not diminished, and China continues to supply them more efficiently than anyone else. In short, China's surplus rises because China has built the world's most formidable industrial engine. It is not a short-term phenomenon. It is the shape of the global economy as it now exists. For the United States, China's trillion-dollar trade surplus is not merely an economic statistic. It is a geopolitical alarm bell. Washington has spent the past decade attempting to decouple, reshore, and restrict Chinese exports through tariffs, sanctions, and industrial policy. Yet the result has been paradoxical. America's influence over global trade has weakened, while China has expanded into new markets that the United States cannot easily reach. The surplus stands as empirical proof that the world economy no longer revolves around American consumption or American strategy. Inside Washington, this realization generates a quiet but profound anxiety. For generations, the U.S. relied on its role as the world's primary import market to exert political leverage. Nations aligned with the U.S., not simply because of its military power, but because access to the American consumer was a gateway to prosperity. The shock today is that China is increasingly replacing this gravitational pull, not in the ideological sense, but in the practical mechanics of trade. If countries can grow by exporting to China's supply chains, infrastructure programs, and manufacturing networks, America's leverage diminishes. Policymakers in Washington also fear a more structural problem, the erosion of America's industrial base. Even as the U.S., Washington understands the stakes. The dollar's reserve status allows America to sustain deficits, project power, and absorb shocks. A world where China conducts more trade outside the dollar is a world where U.S. Economic sovereignty becomes narrower. There is also a psychological dimension. China's success challenges the American belief that its economic model, liberal markets, limited state intervention, and global openness is the only viable pathway to prosperity. China's hybrid strategy, blending state coordination with intense private competition, defies orthodox economic thinking in Washington. To some American leaders, China's surplus represents not just economic strength, but a philosophical alternative gaining legitimacy. Thus, the American response is a mixture of concern, defensiveness, and strategic recalibration. Washington will likely interpret the surplus as a call for more tariffs, more technology restrictions, and more industrial subsidies. Yet these tools may prove insufficient unless the U.S. confronts the deeper truth. China's rise is not rooted in unfair practices alone, but in its comprehensive industrial vision. The United States must choose between two futures, one defined by attempts to obstruct China's ascent, and another shaped by reinvesting in its own productive capacity. But whichever path it chooses, the world it once dominated has already begun to move beyond its orbit. The trillion-dollar trade surplus accumulated by China is not merely an economic achievement, it is a signpost pointing toward a new global order. For decades, the world economy revolved around a single axis, the American consumer, the dollar system, and the Western-centered institutions that shaped the rules of trade. Yet today, the map is shifting. The gravitational center of commerce is dispersing across Asia, Eurasia, and the global South, creating a world no longer dominated by any single power. This transition offers opportunities for some, challenges for others, and uncertainties for all. The first feature of the emerging landscape is multipolar demand. Global growth is no longer concentrated in the Atlantic economies, but distributed among ASEAN, India, the Middle East, Africa, and Latin America. These regions are urbanizing, industrializing, and digitizing at unprecedented speed. China, with its deep manufacturing capacity and logistical reach, has positioned itself as the primary supplier for this rising global middle class. In this sense, China's surplus reflects not an imbalance, but a rebalancing toward regions that are becoming the new engines of global consumption. A second feature is the fragmentation of trade blocs. The world is reorganizing into overlapping commercial spheres, a China-centered supply chain stretching across Asia and Eurasia. A U.S.-centered bloc focused on North America and selective alliances like Japan and South Korea. A European Union attempting to maintain autonomy, but increasingly pulled between the two. This fragmentation is not necessarily catastrophic. It may reflect a more pluralistic pattern of development, but it also raises the risk of divided standards, duplicated supply chains, and geopolitical miscalculations. A third feature is the erosion of the West's institutional monopoly. Institutions such as the WTO, IMF, and World Bank, once pillars of a U.S.-led order, now struggle to accommodate a world where China, India, and other emerging powers demand representation that matches their economic weight. New institutions like the Asian Infrastructure Investment Bank and BRICS partnerships reflect this shift. China's surplus gives it both the financial resources and the political confidence to shape alternative frameworks. A fourth implication is for the United States itself. Washington must grapple with the reality that its traditional leverage, market access, dollar dominance, and technological leadership is being challenged not by coercion but by competition. China's surplus is a symptom of deeper trends: industrial coherence, strategic investment, and integration with the global South. For the U.S., the dilemma is whether to confront this shift through decoupling or adapt to it by revitalizing its own economic foundations. Retrenchment will not reverse the rise of other markets, only renewal can. For Europe, the multipolar transition offers both risk and opportunity. Europe can diversify its partnerships, reduce dependency on any single power, and carve out a more independent role. But Europe must also avoid fragmentation within its own borders, as member states differ sharply in their approach to China and the United States. The most urgent question, however, concerns the fate of the global system itself. Will multipolar trade lead to cooperation, where multiple centers of growth reinforce global stability? Or will it lead to fragmentation, where rival blocs weaponize trade and technology? China's immense surplus, paradoxically, highlights both paths. It shows how interconnected the world has become and how easily those connections could harden into divisions if not managed wisely. The next decade will reveal whether humanity can build a shared economic future or whether it will drift into competing spheres of influence. What is clear is that the age of a single global center has ended and a more complex world has begun.